Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading weekend in September the 11th, 2015. What I have on the screen here is a monthly chart of the SPX, the cash index. And what I wanted to do is, if you remember from our update last weekend, I talked about the good, the bad, and the ugly. And I wanted to kind of continue on that theme this time. I know the markets are we've kind of been prepped for this down move that we had in the month of August. Really, it was about a week period where it was very, very difficult. But what we're looking at here is a monthly chart of the SPX. And, of course, this goes all the way back to the early 90s when we had the decade of the 90s where the markets just took off and exploded. Now, what I wanted to show you here is, and I want to look at a little bit of Elliott wave theory. You can see we had a one leg, a two leg down, three leg, four, and then a five here. And that pretty much was the decade of the 90s that everybody talks about, where we had this just big, massive move up. And the markets were in a bull for quite some time, pretty much through the 90s. Then we had the dot-com bubble right in 2000, 2001. And then we came back down. And then we started another Elliott wave count, a 1 and a 2, 3, 4, and then 5 up here. And you can see here that it was very similar to the dot-com bubble, give or take a few points, and then we ran into a lot of resistance. You can see also on here, there was that bearish diversion spread out, over 8 or 9 years. And then this was, of course, in the '07 peak, and then we just came down hard. In fact, we came down even harder, and we took out the lows that we made previously. And you can see here, just like that, it was a little bit weaker in that '07, '08, or this up run that we had, starting in March, or starting in at this point right in this time here around 2003, 2002, 2003. But we had the 1, 2, 3, 4, 5 move up here in '07, and then we had this big pullback. And then we started in earnest in March 6, I believe, 2009. And then we've got a 1, 2, 3, 4, actually a 1, 2, 3 pattern right here that we're running on again. Okay. And you can see here in this instance right here, the 1, 2 pattern started very early in the bounce, and right here it we drifted up a little bit. We had elongated 1 and a very short 2. In this area here, you could see there were some patterns within patterns. We had a very small 1 and a 2, 3, 4, and 5. And then we kind of started a whole fresh one at this point in time here. We'd already been moving up into 2011, and then 2011 started our 1, 2, 3, 4, 5. 1, 2, 3 pattern right here, which took us to the peak here at roughly 2134 in the futures market. And you can see here on the MACD, going way out in time, that we're about the same height from here to here. I didn't draw a straight line, but you get the understanding. This point right here, we didn't hit the peak that we hit back over here, but this one we did. So it was a good solid move. But you can see the rate of ascent was a space shuttle, and it was very similar to what we had in the 90s. Okay, now we've got this 3, and we're looking at coming down and forming a 4 leg before we make a final run out to 5. Now this is a monthly chart, so as you can see here, from a 3, from a peak of, well, let me just get rid of that right here. From a peak right here of 3 to the 5, that was a little bit over a year, right? I mean, it was about a year and a half. From the peak here of a 3 to a 5, here it happened very quickly. Again, about a year that it took. So we hit a peak here in 3 back in, in July timeframe, July-August timeframe here. And then if we look at a peak of 5, that could take us out to July of 2016. All right, again, this is a monthly chart, so you just have to keep that perspective, that time shift in mind. And then the 4 leg was relatively shallow in the late 90s. Right here, the 4 leg down was relatively shallow and quick. The 4 leg here was very shallow. in 2006 going into 2007, which gave us the peak in 2007 on the 5 leg. So now the question is, what kind of depth are we going to have to this 4 leg here, right? Let me just clean this screen up a little bit and redraw it for you. And you can see here that we've got a 3 here, and now the question is, well, just how far down will we go for the 4 leg? You know, as I said before, the 3-4 there was very tight. The 3-4 there was a little bit elongated, but it happened very quickly, all right, which suggests that the market moved down very fast and then bounced pretty hard. So now we're getting the same type of pattern here in this 3-4. The ugly side of the pattern suggests that we would come down to this area here, which is around 1574. That would be the ugly side of the pattern. The side that the chart calls for is probably more like around 1800 maybe to 1850 range in this area here. That would be what the charting pattern on this monthly chart and weekly chart, by the way, would call for, and then we get resistance here, and then we would start our move up into 2016, giving us a 5 leg there. Okay, so we have to go into a little bit more finer detail. We'll drop it down into the weekly and then the daily, but I just wanted to show you here, you know, the ugly side of this can take us all the way down to 1574, which would be very similar to the peak right here, which will serve as very, very strong resistance. And I don't know, quite frankly, if we're going to get down there. The markets in this down move right here, we didn't know if the banks were going to open. All right, and this was a lot of fear and panic. In fact, the VIX got up into the 70s and 80s. We didn't know if the markets were going to open. This was a little bit more of a controlled downshift here from the dot-com bubble. It was a lot of revaluation because a lot of companies just got tremendously overvalued. And a lot of that just caused the dot-com bubble, but we didn't have the issues with the banks and the lending and paper that just couldn't be supported by underlying assets, secured assets. But this was just a true panic move, okay, which gave us that in this monthly chart, that sharp V bottom. Okay, so right here, believe it or not, even though we had a very tough couple of week period, it's a little bit more orderly. Very strong but orderly in this perspective. So that's why I don't believe we're going to see 1574. My personal view, which doesn't really matter, we got to follow the charts, but I would not be surprised to see us come down to this 1800 again, maybe even a little bit lower, retest the lows that we made earlier, and then find a bottom. I think that'll give more confidence to some bulls, and then they'll be ready for action going forward. So now if we were to zone in or zoom in a little bit more, I think this move, because it happened so fast, caught a lot of people off guard. Okay, so if we take it down to a weekly chart, and let's just zoom in a little bit tighter here. Again, on this weekly chart, you can see this 1, 2, 3, and now we're forming this 4 pattern here. In fact, if I were to put a Fibonacci on this, let's just put a fib on here. We'll go from the bottom of the 2 leg right there, close enough. It was 2134, but that's close enough right here. Let me just get rid of this. So you can see right now on a weekly chart, you can see where the fibs are lining up. You can see right now we're getting a lot of support at that 1932 area, and you can see it was kind of, we blew through it, but we kind of just came right back up to it within about a week. Okay, so and that's why I'm saying I would be more believable, and that's 1805. It's the 38.2%. It's a true fib node right there. This is not a true fib node. 0.236 is one that I use all the time. It works out very well. In a very strong bull market, you'll see markets pull back to the 23.6% level and then just continue higher. Or in a strong bear market, they'll do a bounce up 23.6 and a counter trend move and then roll back over again. So it's a very common one. But this is a true fib node as well as the 50%. You'll see that the 38% is at 1805. So I'm rounding it out to around 1800. The lows that we made in October, to me, and I'm telling our members, it's kind of like our line in the sand. You can see that low there, which we kind of hung up here as well for, almost 6 months, really. Or 5 or 6 months that we kind of hung up right there, and then we came right down just north of the 1805 area in the October huge move down. And then you can see a very similar move right here, where we've got right here on these big huge down moves, and you don't see these. In fact, if we go back in time here and here, and this is 2011, but if I were to take you back on a monthly chart and go way back into the early 90s, you don't see these moves where you've got a candle that has a long tail on it like that. Okay, and the reason why are like that long tail right there. See those long tails on the candles? And the reason why is you don't have the automated trading that you've got now. You don't have the black boxes. You don't have all these sell signals. We're getting rid of the floor brokers, the market makers in a lot of instances. Globex is coming on more and more. So you're getting all these programs that kick in to sell or kick in to buy at the same time. And it's not a two-sided market. So you have these huge, fast move down like this. And a lot of people that have automatic stops on their stocks get killed. They get stopped out. By the time they wake up in the morning, the market's open. They'll get stopped out right away. And the next thing you know, the market's back up 10 or 15%, or their stocks back up 10 or 15% from where they were. And now they're like, now what do I do? So that just scares the hell out of a lot of people. So I think that's why we're getting a lot of these abnormal moves that we're seeing now. All right. So if we zoom in, again, you can see the fibs here. And let's just take it down now to a daily chart. And you can see on this daily chart here the fibs. The green is the 0.236 and the red is the 0.382 percentage areas here. Okay. And if I were to just put in here the October low, and let me just highlight the October low here, you'll see the October low is kind of like what I'm calling with our guys, kind of a line in the sand at 1820. So it's just north of the fib level here at about 1804, 1805, that red line there. Okay. Now, if we look at this chart, a couple of patterns immediately come to mind, right? Again, a weekly chart, so just keep that in mind. In looking at this weekly chart here, you can see that, well, you would think I've been drinking bourbon all morning. Let me just get this here. Let's get this pin going here. Okay, so you can see that huge down move. All right, it's just a stick, and then you've got this kind of move like that, right? That's the pattern like that. Now, if any of you, even it's like one of the most basic patterns, where you can say, okay, well, gee, that's a bear flag or a wedge. I don't care how you want to call it. But for me, the pattern suggests that the potential break is to the downside. Why? Because we entered the market from the downside. So generally when you have a pattern like this, it tends to break in the direction that you were heading prior to the pattern, which would be to the downside. The measuring objective of this pattern is typically the width of the pattern, and the width of the pattern starts at about 2000, and it takes it right down to about, let's call it 1870. So that would be 130 points, right? So you've got about 130 points. So if we measure from the peak here, which is right at about, let's call it 1960 for round numbers, right? And we take 130 points out of that, then we're looking at 1831, okay? 1831 would be the measured defined break. 1820 just happens to be the October low, right? And then just beyond that, at about 1804 just happens to be the fib. So we've got, that's why I said anywhere from 1820 down to about 1800, solid support, and that would be what the pattern calls for. So that's why you're getting a lot of people and a lot of technologists, technical analysts calling for another break to the downside, and I just said, okay, for round numbers, call it 1800. okay? Because you know the markets always overcorrect both up and down. So that is what the daily chart and the weekly chart call for. We're on the daily right now. So you can look at this and say, well, gee, if that happens, you've got to be prepared for this down move. And it can happen very quickly. Now, it just so happens that next week we got the FOMC coming up, right? And they're going to talk about, their interest rates. Are they going to raise them in September, or are they going to postpone till December? The analysts right now, the bet is they're not going to raise the rates this week, all right, to 25 basis points, which is 1/4%. Now, in the scheme of things, over a 2 or 3 year period, 25 basis points is absolutely nothing. But if they do raise them, it's going to catch the market off guard, and then that would be a catalyst probably to drive us down into this area down here. And it'll be ugly, and you'll see vol pop again. And then once we get down in this area here, a lot of people ended up selling their positions right in this area here. They're in cash. If we go down to that area, we'll start to get that bullish run, and then you'll get a bounce, a little bit of a counter trend, and then we'll start our movement back up like that. It'll be choppy, but that's what the markets are suggesting. So what's the catalyst? Well, again, we got the FOMC meeting next week. They raise the interest rates. Boom, you got that. You got a catalyst that can move it down. All right. So I'm just giving you guys an idea of what next week can foretell. Now, another way to look at this, and I'll present a counter or a contra view to this. Let's come into a 2-hour chart. I like to use the 2-hour chart against the daily because it really gives you an x-ray view of just where we are really short term, real near term, all right? And if we look at this 2-hour chart right here, we've got a pattern that has set up. Again, there is the, and I would highly recommend that you draw this on your chart with, better drawing tools than me just hand drawing it on here. But you've got this pattern here. Now, taken in and of itself, that is a symmetrical triangle. And the percentage break is 50-50. 50 up, 50 down, meaning you got a 50% chance it's going to break to the upside. You got a 50% chance it's going to break to the downside. Then what you do is you come over here and look at how did we enter this pattern. In this case, we entered it from the downside. So that would probably skew the potential break to the downside, but just a little bit, not a lot, not like 75-25. I would still say it's probably around a 50-50 potential break. Again, we've got a key level right there, a key pivot, which is at 1992, roughly on the E-mini futures. And at that 1992, if the Feds do not raise their rates and they come out in a dovish fashion and they talk about, they're going to look at it again, the global community, blah, 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 and all that kind of stuff, we're going to probably get a break to the upside. Again, the measuring objective is pretty strong. It'll take us back up to around this area right here, which would be that low right in that area there, right around 2060, maybe 2040 area, somewhere in that area there. That's where it can take us. Now, let me just get rid of these things and I'll show you the key hurdles that we've got to overcome to the upside. Just like to the downside, we got some good support. To the upside, we got some very solid resistance. So let me just squeeze this in, and I'll draw these in for you guys so that you can see here. And let's take it back to the daily. So we'll be able to look at 2015 in its entirety here. All right. So in 2015, there's two key areas. One is right at this area right there. Okay, and the other is right roughly, let's call it that area there, okay? So we've got two key resistance zones here for 2015. And obviously, price action, the near-term price action carries a stronger weight than price action 2 years ago, price level-wise. So you can see this is the first key level of resistance. There. This is the second key level of resistance. So I would call this R1. I would call this R2. And then there is our pattern, right, like that. Okay? And there is the flagpole, if you will. So you can see that we were in R2. It served as a great support point all the way back to March, right? Going into March right here, you know, for most of the year, all the way until we gave it up in the middle of August, we just stayed stuck in this pattern right here. Um, and only for a very brief period of time in January, coming into February, did we test the 1989 area, but we just stayed away from it. So we've got two key levels we're going to watch. If we break to the upside, if we get back, and let me just clear this up just one bit for you guys, and if we get back into this area here between this guy and this guy, I could see us being sandwiched here for a while. Okay. And if we break this guy, then we're going to be up in this area here and we'll be free to roam a little bit. So that is kind of where we're sitting. The other thing I wanted to show you is look at on the cash index, the 50 and the 200 EMA. They haven't crossed yet, but I guarantee you they're going to cross probably early next week. We got a cross. There's called the death cross. We got that cross on the Dow for sure. So typically, and I said this in other weekly updates or weekly roundups, when you get a cross, because of the timing of the cross, generally at the time of the cross, you get an up move. Why? Because it's lagging so far. That means you had to have a huge sell-off to get the 50 crossing below the 200. So by the time you get across, you generally move up to the cross and then you roll back over again. So if the cross happens around the 2039 area, right? And we're sitting around 2061 right now. Wouldn't surprise me to get a dovish Fed. The markets move up into this area here. Then you're going to see the 200 and the 50 EMA moving down like that. It runs into resistance and then we roll back over again. So I guess what I'm saying is, even with this cross right here, and then these guys are moving in a trajectory like that, and then we get a break to the upside, we could run right up to that point there and then roll right back over again, take that out, and come down and test somewhere down in this area again. I do not believe the downside is done yet. We may have put in a low, okay, but I do not believe the downside is done yet, meaning from where we are now, we could come down and at a minimum probably retest these lows, okay? So we got to be careful. So what I'm saying is, even if the Feds come out dovish and we get a move up into this area, be careful, folks, because the market is very weak. And all it'll take is China to come out and say, well, you know, we said our GDP was going to be 7%, but we really lied. It's going to be 6.2% or in the high fives. And you'll see the markets give up 400 points because China will continue down. And then we'll go right back into the emerging market issue of weakness, commodity weakness. You'll see oil continue to go down, which it was forecast to do with overhead supply. So there's not very much that in my mind is propping the market up from a good news perspective. Okay, it's just I don't see that. Again, we only trade price action. I don't listen to the news as a trigger to say, do I want to go long or I don't want to go short? I don't really care. By the time you hear good news, the market's already made 60% of the run. And then it's ready to roll over, or vice versa. By the time you hear all bad news, you probably want to take a bullish position because most of the bad has already been factored into the price action. Remember, the markets are forward discounting mechanism, so it generally looks at where the price is, not today. I don't look at headline news today. I try and anticipate 30 and 60 days out. And the best way to do that is just use price action. So this is where we're sitting right now. I wanted to spend a lot of time on this so that you guys just understand the patterns and what can happen. For our members, we got a session this Sunday night, 8 p.m. New York City time. We'll go into the market for next week, what to expect. We'll look at some individual potential securities that we can go long. We've identified some long or short. And then we'll break off volatility. We'll look at how we can play vol. We've got a vol play on now, a little bit of a longer term vol play. Also, for those of you that are non-members, we'll probably run our Blue Moon special through the actual Blue Moon. And you should I would highly encourage you to take advantage of it because we're having a good time this year. and the markets are really treating us nicely for those that are following along. All right, everybody, I want you to have a great weekend here. Looks like school's back in session. The markets are going to start picking up in September and October. So let's just kind of see how this thing resolves itself. Have a great weekend, everybody. And for our members, I'll see you tomorrow night, 8 o'clock New York City time. Ciao, everyone.